internal liability and another is external liability. Now the liability towards the owners or the proprietor or partners of the firm will be there, that will be considered as internal liability because there is no external party is involved here. Another is external liability. This liability are towards the outsiders, or we can say that other than the owners, proprietor or partners. Here the party outside that firms are involved. That is why it is called external liabilities. Now we'll see the reasons for this external liabilities, why they arises. So these liabilities arises because of the tragic credit transaction of loans that has been taken by the firm, like creditors, bank overdrafts, long-term borrowings and other liabilities. Now this liability we can classify in two manners. First is non-current liability and another is current liability. So what do you mean by non-current liabilities? So these are that liability which is payable after a period for more than 1 year from the date of accounting period. For example, long-term loans and debentures. Second is current liability. So this is the liability which is payable within 12 months from the date of accounting period. For example, creditors, bills payable and short-term loans. Sixth term is assets. Now these assets are the properties owned by an entity or enterprise. Means that assets that firm or enterprise they have purchased. Now these assets can be tangible assets or intangible assets. Tangible means assets which are having physical existence, and intangible means which are not having physical existence. Further it will be explained. Then these assets are considered as the economic resources of the business, and these are because of this that firm they are able to get the economic benefit in the future. Now we are having some examples of assets here like building machinery, land, stock, cash, cash balance, debtors, trademarks, copyrights, goodwill, etc. Down we are having few definitions. First definition that is given by Finney and Miller. Assets are future economic benefits, the rights which are owned or controlled by an organization or individual. Second definition that is given by R. Brockington. Assets are property or legal right owned by an individual or a company to which money value can be attached. Last definition is given by Professor R.N. Anthony. Assets are valuable resources owned by a business which are acquired at a measurable money cost. Now when we are reading or seeing all this definition all together, they are giving some characteristics about the asset that we will discuss. First is it should be owned by the business. Means this asset should be purchased or owned by the business, and that will be the property of business only. Second is that can be in tangible form or intangible form. Tangible form means that assets can have physical existence. Another is intangible form means they are not having physical existence, means we are not able to see or touch. Third is it should have some value attached to it. Whenever that assets will be purchased, some value will be attached to it. That particular asset should have some value. Fourth, it should be capable of being measured in terms of money. That particular asset should be measured in terms of money. Means it must have some monetary value. Now these assets can be classified into three. First is non-current asset, another is current asset, and third is fictitious asset. Now first we'll understand about non-current assets. So those assets which are held by an entity or enterprise not with the purpose to resale, but are held either as investment or to facilitate business operation, that kind of assets will be considered as non-current assets. Means that firm, they are purchasing it for the to increase their business and to take help of that particular assets for the business operations, but not for resale. And these assets are with the firm for long term period. Few examples are given here, like non-current investment, long-term loans and advances, or other non-current assets. Under this we are having fixed assets. Fixed assets are those non-current assets of an enterprise which are held not to sell, not to resell, but with the purpose to increase its earning capacity. In this we are having two kinds of assets. Tangible assets, those assets which have physical existence. Another is intangible assets, those assets which do not have physical existence. Now we'll understand with the help of example here. Examples of tangible assets are land, building, machinery, computer, furniture, etc. An example of intangible assets are patents, trademark, goodwill, and computer software. Next is current asset. These assets are those assets which are held by an entity or enterprise with the purpose of converting them into cash within a period, and that period is 1 year. Now take an example. If goods are purchased with the purpose to resell and earn profit, then debtors exist to convert them into cash, that is, receive the amount from them. Bills receivable exist again for receiving cash against it, etc. Means when that any purchase that goods purchased are there, that time that company, they have not paid that money at the immediately, that time that will be considered as credit transaction. Now when that cash will be received against that transaction, that time that particular debtors, they are converting into manner of cash. And there are some prepaid expenses also, they are classified as current assets, as they are not although we cannot convert it into cash, but it is classified there because this expenses is available in the next accounting year. Third is fictitious assets. Now these are those assets which are not falling under tangible category, not in intangible category of assets. Basically these are the kinds of losses that are not written off in the year when they are incurred, but they will be that losses will be there in more than one accounting period. Now in this case we are having example of deferred revenue expenditure such as advertisement expenditure. Now understand the meaning of deferred revenue expenditure. It is an expenditure which is a revenue in nature, but and incurred during the accounting period, but its benefits are incurred in the future accounting periods. Means as in advertisement, when a company, they are investing or they are having that expense of advertisement, that time they are not bearing that whole expenses on that particular accounting year only. Its account expenditure will be carried out for the next accounting periods, and that benefits will be earned in the future accounting periods. This much for today's class, and next we will meet with the rest of the accounting terms. Thank you.